You can't be in real estate if you can't figure out how to tell a story to potential investors.
Welcome to the Service to Syndication podcast, where we interview the biggest and most successful real estate entrepreneurs, investors, capital raisers in the world who have worn the uniform of this great country, those who provide services to our men and women in uniform, and other service-oriented professionals to provide you with the tool sets, the mindsets, and the skill sets to help you conquer your dreams and goals in real estate and to use this wealth creation vehicle so you can live a more successful, happy, and fulfilled life of generosity and prosperity. If what you desire is time, lifestyle, and financial freedom, you've come to the right place. We will bring to you the best real estate entrepreneurs who will give you the insights, the knowledge, experience, skills, so you can go out and crush it in whatever real estate asset class you desire. So grab a pencil and paper, sit back, and enjoy the ride on the Service to Syndication podcast. Hello, my servicemen and women and other service providers. Welcome to another episode of the Service to Syndication Real Estate Podcast. I am your host, Cedric Marlow. I am a U.S. Navy vet. Here on the Service to Syndication Real Estate Podcast, we interview the most successful real estate entrepreneurs, investors, capital raisers in the world, where most have donned the uniforms of our great country. We aim to provide the tool sets, the mindset, and the skill sets for you to achieve your personal and business goals while using real estate as a wealth creation vehicle to help you live a more successful, happy, and fun-filled life. I am super excited today because I have with me top-notch real estate economist and commentator, Mr. Mitch Rochelle. But before I properly introduce our exciting guest to you, I want to ask a favor of you. Please, if you get some value out of today's interview, if you get some type of insight, mindset shift, if you learn a new skill, new information, receive inspiration or motivation to go out and take some action to make some progress in your life, please share this episode with some of your friends. Send it to someone you know who might be or could be interested in real estate. Share it on your social media, post it on your wall, or share it in your stories. Help us spread our message while you help others. And for all of you who share this episode, I want to say thank you. Again, everyone, I have Mr. Mitch Rochelle. He is a recognized expert with over 3 decades of consulting experience in real estate, housing, finance, economy, business strategy, and capital markets. The vast majority of Mitch's expertise was developed throughout senior leadership roles during his 37-year career with PwC in various practice areas such as real estate, assurance, advisory. His niche areas of expertise, in combination with culminating years spent leading business development, go-to-market, thought leadership, and content creation, results in a unique viewpoint and voice that he now shares with global audiences. In the next chapter of his career, Mitch shifted his expertise to a wide audience base under his independent firm, Macro Trend Advisors. Mitch now is a sought-after media commentator, thought leader, podcaster, public speaker, and brand ambassador regarding all things real estate, housing, finance, economy, and capital markets. Mitch is a regular guest and panelist on Fox Business News and Fox News, Bloomberg, News Nation, Cheddar, and OANN. Additionally, he co-hosts the weekly podcast No Po Podcast, is a visiting research fellow at the University of San Diego, serves as a keynote speaker at nationwide events, and partners with select brands. All right, Mitch, again, welcome. And one of the first things that I like to do with my guests is I ask them to go through their real estate journey, in this instance, your total journey, in about 75 seconds or less, and then we'll unpack that from there.
Fair enough, Cedric. Thanks for having me. Thank you, of course, for your service to this great nation and to our listeners as well. So here's the interesting thing. I didn't find real estate, it found me. When I started my career, then Coopers & Lybrand, which became PwC in 1998, I was literally sitting around. I was available. I thought I was going to work on this client, which was a bank. I was sitting in a room where people who were available sit. Somebody came in and said they need me for something. It happened to be a real estate company. It's a really, really quick story, but it sort of informs the way I think about things, and I'll still keep it within 75 seconds. But they told me I was going to Hart's Mountain. That was the name of the client. Hart's Mountain, if you recall, if you're old enough, sold birdseed. Okay, that was if you were in a supermarket or a grocery store and you went down the pet aisle, Hart's was the brand. That was most of the pet food. So I went to the library, because this is the early 80s before the computer. And I did all the research I could about Hart's, because I was going out to this client and I wanted to know everything. So I did all this research about Hart's. I get there to find out that it was a real estate company and that Hart's had two arms to it. One was their brand, their operations in the pet food business. And then basically, since that was a big cash flowing business, they used that cash flow. And at the time, the tax laws were favorable. So they sort of sheltered the profits from the pet food company by investing in real estate and taking advantage of all the depreciation benefits that used to exist. In any event, that's the story of how I found real estate. It found me. I liked it for some reason. I thought it was interesting. And that's the truth. The thing I hate, when I interviewed people throughout my career that had a real estate major, and I said, why real estate? And they gave me this lame answer like, oh, it's a tangible asset class and you can touch it. And like, you can't touch a stock or a bond. I'm like, oh, that's a lie. Like, at least my answer is truthful. I wasn't looking for it. It just kind of showed up on my doorstep. But I've always had a thing for it. It made sense to me. And that's how I started my journey.
Great. Nice. So I read your bio. So entrepreneur, a real estate consultant, media commentator, public speaker, educator, and let's not forget the most important job, being a husband and father. Where do you find the time?
Well, I retired in the middle of COVID from my 4-decade career at PwC. And my kids who were in college at the time were actually in our house. And, Taco Tuesday, I bought a Traeger. One week I'd smoke a brisket. Next week I'd smoke a pork shoulder, bone in, of course. Next week I'd smoke ribs. Like, it was like something to do. And we spent a lot of time together as a family because literally you couldn't go anywhere, right? It was during that time that I sort of realized for the next chapter in my career what was really important. And in part, at the tip of the spear, it's family, right? And at some point, we decided to pick up and move to Florida. I still have a heat rescue plan, which is I still have a home in New York. So when it's August and September in Florida, don't know if you've been to Florida in August or September, yes, but you want to get the hell out. So I still have a house up in New York, but I have a house that sort of became a place where the kids want to be there. They want to bring their friends. So I maximize time with my kids. I told one of my business partners this months ago and happened to have reiterated it yesterday. At this point in my professional life, I think the only thing that's important to me is taking everything that's in here and passing it along to my kids. Like, if you die, I know sadly we were talking about funerals off air, but if you die and you bury intellectual property in that box, like, you can give all the money you want to your kids. If you don't pass IP, intellectual property, to your kids, you're doing them a disservice and you're doing your legacy a disservice. So I try to prioritize time with my family. One of my kids I sort of work with, a lot of dotted lines there in an org chart, but I work with. I wouldn't rule out the notion that I work with the other one. If a situation came along where there was some business that would be phenomenal to buy and have my kids work in, I'd do it to work alongside them. I'd drop other shit that I'm doing. And honestly, I would do that. But I think it's a matter of what's the most important thing to you. I'll say this because the service is the first word in your podcast. At PwC, amongst other things, I was largely responsible for a lot of our community service outreach. And when my kids were younger in school, I used to drag them with me when I did that. I would say that I've cut back on that considerably in retirement just because you have to reprioritize things. And instead of educating, and that's what I did. I taught financial literacy in inner city schools across America and in some places abroad. At this point, my goal is to educate my kids on the job as best I can. And I think that that's frustrating, but I think it's rewarding. And that's the kind of stuff you find time for. Yeah. Does it mean I play less golf? And you know what? Things that I find that I have in common with my kids, like from a hobby perspective, we participate in. Like my kids don't play golf, so I'm not running out to drag them to play golf to do something they don't like to do. My kids love to fish. I love to fish. So whenever they're in Florida, we book a fishing trip. And I think that that's what becomes really important at the end of the day. Family, 100%.
Yeah. Yeah. I totally agree with you on that. Family, there's nothing else, that's all you got in life, really and truly. So, yeah.
Right. So who's going to show up at your funeral? Like we talked about funerals, like, and what are people going to say about you at your, there was a Curb Your Enthusiasm episode. I don't know if you watched Curb.
Yes.
Where Albert Brooks wanted to have a funeral that while he was alive so he could hear what everybody said about him. You don't get to hear what people say about you after you're gone. But I think you spend your life perfecting, hopefully, an authentic narrative about who you are as a person. And that's what's equally as important, right?
Yeah. Because those are the things that live on, your legacy and the things that you're currently doing with them. I totally agree with you on the intellectual property piece. Who wants to be the smartest man in the grave? So, yeah, pass it on. Yeah. So, you talked to us about Hart's Library. And so can you share your journey to becoming a recognized expert in real estate, housing, and finance?
Yeah. So I was just a regular service provider, probably with opinions, but I didn't have a stage for them. It wasn't like I was looking for a stage for them. One thing I'll tell you, that getting up in front of an audience and speaking was never one of those things that I was intimidated by. Do you get butterflies? Yeah. But like, I wasn't one of those people that, kill me before you let me be on stage. While I was at Coopers and Library, which became PwC, we ended up buying a couple of pieces of real estate thought leadership. And one of which is Emerging Trends in Real Estate, which I think is in its 47th year or something like that, if I did that from memory. It's a kind of a great story, which I'll say quickly. It was the most highly regarded piece of thought leadership, an annual forecast for the real estate industry, that literally was sitting in a dumpster that the owners of it couldn't afford to maintain, because there's a maintenance cost to keep something fresh because it comes out once a year. So we bought it. I always joke, in the real estate world, we bought it for its unpaid property taxes, right? And we bought it, and then we needed to make the platform bigger. So we did a joint venture with the Urban Land Institute, which is the largest real estate trade group in the United States, if not the world. Very well organized in the United States, modestly organized around the world, varies continent by continent, country by country, but in any event, we were able to use that platform. So we took a 110-page publication and we put it on a stage at ULI's fall meeting with 3,500 people in the audience. And then the way ULI is organized, they have local chapters known as district councils. And they wanted to have events locally because they provide content to their members. And we were the most sought after content. And I would take that show on the road, literally. And I would do, probably over the course of a year, I would do about 75 public speaking engagements. I would say 45, almost 50 of them would revolve around emerging trends in real estate. It was a phenomenal door opener. It was a phenomenal relationship builder. I would literally get off the stage, do Q&A, whatever, talk to people, and then they'd pull out a calendar and book me for the following year. I kind of learned a lot about public speaking. And then somewhere in that journey, I started doing television because we had a PR budget and we try to get the thought leadership out there. And I have stories about how I became a regular on television, but I like doing it. It's funny. I'll tell you, since this is such a intimate setting here, you and I, not this big audience. There was one time I got bumped from television, and that is totally a privileged problem, right? Like you have nobody to whine to when you get bumped from television. And I have a very good friend that did a lot of television too, morning television, which I did a lot of morning television. And I called her at like 5:30 in the morning, telling her I got bumped. And I said, Gene, there's nobody to whine to when you get bumped from television. She goes, we're going to make a deal the rest of our lives. When we get bumped and we're pissed, we're just going to call each other because no one else is going to care. I ended up talking to one of the anchors, I don't know, a week or so later. And for some reason, getting bumped that time really stuck. There was something about it that really bothered me. Like I couldn't shake it. And I said to her, I must be some sort of a narcissist if like being bumped is bothering me so much. And she said, no, you're not a narcissist. She said, you are the opposite. You actually have this need to share things with people. Like this isn't about yourself. It's about the knowledge that you have and you want to impart it on other people. And what you're pissed about is you prepared for something and you had something to say and nobody let you say it. And she says, you speak publicly so often, you're accustomed to having a mic and a big audience and nobody's stopping you. Okay. And now somebody stopped you and it pissed you off. But so it's not all, one of the daisies and rainbows, but I've been doing it a long time. I now no longer get annoyed when I get bumped. The only time I get annoyed when I get bumped is if I'm doing something in Florida, I'm hanging out, completely relaxed. I look at my watch and I go, oh crap, I have to be on the air in 15 minutes. I run upstairs, take a shower like I did for you, by the way. Run upstairs, take a shower, get back down in a chair and look at my phone, which I hadn't looked at. And it's one of those texts saying, sorry, breaking news out of whatever. We're going to have to cancel your segment, but we'll be in touch soon. And I was like, I took a shower for nothing. But, TV's been a lot of fun and it's intellectually rewarding. And by the way, why I do podcasts, because they're long form. You get to have a bigger conversation, but you get to use your brain. I've seen dementia and Alzheimer's in my family and stuff. And they say the best way to prevent that kind of thing is like continually stimulate your brain. So you see all these old people, and I'm in Florida, so you see a lot of old people like doing Sudokus and all these games on their phone to stimulate their brain. I do this. Like, there's nothing better than a live broadcast because you didn't send me any questions. Quite honestly, Cedric, I had no idea what you wanted to talk about, which is fine, like totally fine. But it's stimulating. I hope audiences get something out of it. And I hope, that's your job to ask me things you think they care about, and I'll respond as best I can. But it's good for me. Hopefully it's good for them.
Yeah, I'm quite certain. We'll definitely make sure they get something out of it, as always.
Fair enough.
Yeah. So during your 37 years at PwC, what are some of the pivotal moments that shape your approach to consulting in real estate and capital markets?
I will say not just the global financial crisis, but the fact that I once was speaking publicly and I showed a chart that looked like the trigonometry sine curve, like this roller coaster. And I talked about how real estate was a cyclical asset class, but I didn't use that word. And somebody in the audience raised their hand and I said, yes. And they go, I didn't realize real estate was so cyclical. And I was like, boo, I like, holy crap. Like, it's so obvious to me, but it's not obvious to everybody. That's the thing I love the most. And that's the thing, to your point, that's what's pivotal, which is we built our real estate consulting practice in the 80s in the midst of the savings and loan crisis. At 27 years old, I was literally running a bank, 3 banks, which we consolidated into one, in Waterloo, Iowa. The business offices were upstairs. The branch was downstairs. It was a single branch bank. It was a savings and loan, mind you, not a bank. And I would go downstairs every day and take keys to houses. People were packing up the truck, leaving town, and dropping off the keys to the house. I didn't know what the hell that was. I didn't know what to do. I was 27 years old. I made a bunch of phone calls. There was no cell phones, barely had computers, didn't have an inventory of all of the loans so I could even check it off a list. Like, I had to get that from someplace. Don't forget, there was a bank that got taken over by the government. So I spoke to lawyers and whatever, and they gave me a quit claim deed, which was like 1 page, and a general release of personal guarantees. We had a notary. It was like a local realtor who had no business anyway. So we paid her like $150 a day to just sit in a branch because everything needed to be notarized. And I would take 20 deed in lieu of foreclosures a day. Okay. You talk about pivotal, you talk about an education in real estate. Like these are the things like, God, I wish my kids were alive at the time to have seen that. I rode the curve from the savings and loan crisis to the government figuring out how to monetize all of these commercial mortgage loans that they had on the books and create syndications. And I worked on some of the first CMBS, commercial mortgage-backed securities transactions. The government needed to manage all these assets that they had taken over. They created the RTC, the Resolution Trust Corporation, and we became something that my firm couldn't do today because of regulatory stuff. But we had $2.5 billion of assets under management, troubled loans for the RTC. We realized that the RTC was taking our loans away once we fixed them to stick them into the securitizations. We formed a joint venture. We became a special servicer with a bank, and we were a special servicer in CMBS transactions. Then I realized securitizations were going to become a private sector thing. So we started working on securitizations. Okay. Then M&A became all the rage. And it was interesting. REITs, which were this kind of brain dead, nobody wanted to talk about them, nobody wanted to touch them asset class. REITs became the primary vehicle to roll up all of this real estate that was owned in fee by former syndicators. So we worked on some of the first REIT IPOs. I actually wrote a book with two of my partners, like a pamphlet about like everything you needed to know about REITs because nothing existed. And then, rode the curve. Then the financial crisis comes in 2007. The year before the financial crisis, my biggest clients, I kid you not, Cedric, Bear Stearns, Wachovia, I'm leaving one out, Countrywide. Those were my biggest clients. Next year, they were gone. Okay. Had to reinvent myself again, had to reinvent the business again. I had 100 and something people working for me. And all of a sudden we went from being busy as hell to nothing to do. So I think the pivotal moments in my career was being a leader, riding that roller coaster, having people who work for you who looked to you for things to do and developing them along the way, passing IP to them. One of my partners now has met, I think, 4 people who used to work for me that are in the real estate diaspora. Like we're working on a deal and one of those people. And he said to me the other day, he goes, these people, like I met so-and-so, he goes, he had nothing but great things to say about you. I'm like, I look at the deal, I'm like, you surprised? Because I treated them like my own kids and I tried to develop them, try to turn them into the adults that they are today professionally. Lost sleep over worrying how I was going to keep. I always referred to people who worked for me as kids, always worried about it. But those were the pivotal moments because when you have to reinvent yourself professionally, that's the most stressful thing and most rewarding thing simultaneously. Saying, gee, we have this bag of skills. How do we redeploy it in a different way? Because somebody needs something. I'll leave you with this, maybe your next question, but you mentioned in the intro that I got involved with marketing and sales at PwC. The last 4 years of my career, management team of the firm pulled me out of my role in real estate to pave the way for whoever was going to be next to rise, because there was no opportunity for somebody to take over from a leadership perspective if I was hanging around the hoop, right? So they put me in a different role. And I was offered the job on a Friday. I was told I had to give them an answer on Monday. I was flying out Saturday morning to the Florida Keys to go fishing with one of my kids. And I said on the way out of the office, I said, who were the people you consulted in order to decide that I was the person for the job? And they rattled off the names, including the chairman of the firm. I was like, okay. I said, can I call them? They're like, I don't see why not. I called every one of those people, 4 of them, and I asked them one question. Why me? Just want to know, why me? And I got 4 for 4. They all said the same thing. You see things other people don't see. And I'm like, give me an example of something I see that nobody else sees. Our mutual fund practice, that had nothing to do with my world, was putting out an annual report on the mutual fund industry, similar to what I did in real estate. A lot of people try to replicate what I did in real estate. And on the cover, they had a car and a side view mirror. And I saw that, like literally the PDF of it before it was about to get launched. And I'm like, this is the worst cover I've ever seen on a marketing piece. And the dude who ran the practice, I think, was going to stab me in the head. It's a letter opener. And so I made a big fuss over it. And I said, the mutual fund industry has a phrase that almost everybody knows. Past performance are not indicative of future results. Everybody's heard that. You have a cover with a side view mirror, which is looking backwards. The title of the publication said future. And you literally have a side view mirror on the cover looking backwards in an industry that says past performance is not indicative of future results. You can't send this out. And it caused a political poop storm, okay? But when it got up pretty high up in the firm, somebody said, who caught that? And they were like, that troublemaker over there. And I was like, all right, I'm never going to forget that he caught that. So somebody came back to me and he said, so-and-so's really pissed. He said he's never going to forget that you caught that. And I was like, I believe that was a compliment.
Yeah.
So that's just kind of the guy I am. You know, like you didn't have to tell me after 9/11, if you see something, say something. So I think that, you know, I just gave you a couple examples of pivotal things like those are I think that's what paved the way for me to, and by the way, the last word in your podcast is syndication. Like you can't be in real estate if you can't figure out how to tell a story to potential investors. Like I spent 40 years telling stories. I actually taught storytelling as a exercise at one point. And when I'm an adjunct professor of sorts at University of San Diego, I don't teach a credit class, but I guest lecture into, you know, all the professors' classes in the real estate program. And one of my trips out there, I did a whole thing on storytelling. I think that's what, so I learned, you know, you pick up, I tell you, half the skills I picked up in my career had nothing to do with cap rates, discount rates, prices per square foot,
right?
Comps. It all has to do with how you get, you know, a great idea into investors' hands, right?
Yeah, I totally agree with that. You know, it's about the story that you can relay to your investor, that it makes sense to them, something that they can totally articulate and visualize. They have to visualize it in order for them to open up their wallets to invest alongside you. Totally agree.
And by the way, a Bitcoin.
Wow.
It's a hundredth of a Bitcoin. I keep it on my desk as a reminder. Like, you can't explain this to people.
No.
Like I had Enron. I had a rule. It was my mother, now my mother-in-law. Like if you can't explain to your mother or mother-in-law or your father-in-law, it's not that women don't understand. You can't explain what the hell Enron did. You should not only not invest in it, you should sell it, right? Bitcoin's the same way. And I have this argument with one of my kids all the time who's like caught into the Bitcoin hype. And like, I get the limited supply thing. I get the use cases. I understand the distributed ledger and blockchain. I get it all. Boy, if you try to explain blockchain technology to people and the first two words out of your mouth are distributed ledger, just stop, because like you can't explain distributed ledger to people.
Yeah, people would be lost. Heck,
yeah.
I'm lost, even though I know about it and have heard it. You know, I'm still at times like, what? You know, it's still foreign to people, but you know, and it's funny because I have this rule that I say is that when I explain things, I explain it so that a 5-year-old can understand.
Yes.
Fifth grader, I say fifth grader. A fifth grader can understand it. Like, that's how I do it. And I'm telling you, I've been on podcasts. I've been at conferences. I've been in masterminds, and people are explaining things. And I'm like, wait a minute, wait. Dumb it down for me, please. Dumb it down for me. Like, you know, let me understand what you're talking about. That way we're on the same page. So,
you know, I look up to great communicators because it's a life learning exercise to become. I'm constantly trying to improve my craft. And one of the greatest communicators that I know is Dana Perino. She's on Fox News. Dana was George Bush 43's last press secretary. She happened to be the first female press secretary for a Republican president, but I could care less about first. I mean, nothing. She was either good or she wasn't. But Dana's a phenomenal communicator. And Dana one day texts me, we're good friends. She texts me and she says, I have Alan Greenspan on at 2:10 what the hell do I ask him? And I banged out a bunch of questions. I sent them to her. She responded with the heart emoji, and that was that. And the next week or the week after, Jerome Powell, was it Powell or was it Yellen at that point? Don't remember. Maybe it was Yellen at that point. Does the Wednesday presser after the Fed meeting. And they talk, amongst other things, about the economy, but most important thing everybody cares about is interest rates. And Dana had me booked. And when she introduced me to the audience who knew me, but she introduced me for the segment, she says, nobody can put Fed speak into English like my next guest, Mitch Rochelle. And I had a long conversation with her about it. And she said, one of the most intimidating things to journalists that have to cover the Fed live at 2:00 is not knowing how to put all the pre-packaged words that come out of his or her mouth into English. Like, what does it mean? What does it mean to the average? The Fed lowered the federal funds rate by 25 basis points. They don't even start with English. Instead of saying 1/4%, they say 25 basis points.
Yeah.
What does that mean to Cedric? What does that mean to Mitch? Nothing. It means nothing. Okay. Everything else matters. What is he saying about the economy? What is he saying about inflation? What is he saying about the labor market? Okay. That could matter if you're looking for a job, if you're out of work. Like, what does that mean? That matters. But the interest rate's going down. If you have credit card debt, they're not changing your interest rate. If you have an existing mortgage, you're not going to refinance it, because that changing the federal funds rate 1/4 point may have the unintended consequence of raising the 10-year treasury by 50 basis points, like we continue to see, right? So, how do you explain what all that means to people so it matters? And I think you're 100% right, Cedric. Like, you have to explain it like a fifth grader can understand it. Fifth graders may not understand mortgages. But I'll tell you, one of my greatest training exercises ever was teaching financial literacy to 3rd through 5th graders in New York City public schools in at-risk neighborhoods. And let me tell you, when you had to explain money to 3rd graders and 5th graders, if you were paying attention, you really developed your skills to speak to big audiences. Because the second you assume that just because people are wearing suits and ties, they know anything, you can speak down to the biggest audiences by dumbing it down, and they're going to think you're great. Yeah. You use big words because you want to impress them about how smart you are.
Yes.
This is why I never go on CNBC. CNBC, sorry to trash them on your air, but CNBC, all the guests try to impress the anchors with how smart they are. Your audience isn't the anchors. Your audience is the 200,000 people that are watching. Don't try to impress them either. Try to educate them, right? That's what they really want. That's why they're watching. Yeah. And you know what? You're not going to insult anybody saying it in a way that a 5th grader can understand.
Not at all. Not at all. Yeah. So with your extensive experience in real estate, how have you seen the industry evolve over the past 3 decades?
I'll say the number one thing that has happened in real estate over the last 3-4 decades is the reincarnation of the REIT. Because it completely democratized real estate ownership, right? You can own one share Simon Property Group and own iconic mall, a piece of an iconic mall. You can buy one share of Boston Properties and own a office building. You can own one share of Prologis and have a piece of the supply chain of the world. Okay. You can do that with data centers. You can do that with cell towers. Like, I could do a whole show on what's good and bad about REITs. But to me, the biggest game changer was the democratization of real estate investment. The other thing that I think has yet to evolve, question you didn't ask, what has yet to evolve is how moderately wealthy people, meaning individuals, families that have, let's say, $5 million of investable assets, non-single family resident investable assets, to $10 million worth of investable assets. And I mean, when I say single family, not primary residence, not secondary residence. I mean, just money that they have in cash, CDs, stocks, bonds. If they want real estate in their portfolio, and I would argue they should have real estate in their portfolio, they should have alternative investments in their portfolio. They have very, very little access to them. If they have a financial advisor, who, regardless of how they compensate the financial advisor, that financial advisor is only going to sell them products that he or she has the ability to sell if they're a regulated institution, or that they get a big commission on. Okay. And I think the broken thing, and it pains me, the broken thing in real estate is the fact that there's all of these people who want to invest in real estate. Their only choice is REITs. In many cases, their only choice is non-traded REITs because that's what they buy from brokers when they ask for REITs. That's the worst thing they could possibly buy. And they can't get access to people who syndicate equity in real estate deals, with slices that are as little as 50,000 or minimum of 250, depending on what the deal is. Some of those investments are incredibly suitable for those investors. And that's the one thing that I've seen in 40 years that worked great and then stopped and still has yet to work great again. It used to be before the savings and loan crisis, when syndicators were all the rage, that they could sell that product out the yin yang to people and they had access to them. Post savings and loan crisis, it shrunk up. Then the REITs came. But there's no real pathway for retail investors to get access to institutional grade, institutional managed real estate that's not in the form of a REIT, or worse yet, in the form of a non-traded REIT. And that's the one thing that evolved for the better was the REIT. The one thing that hasn't evolved and really should is the real estate syndication. And by the way, I'm not saying that because it's in the title of your podcast and I'm telling you what I think you want to hear. It is a tremendous source of frustration. And my firm, Madison Ventures Plus, where I'm a partner in addition to my consulting practice, but we've tried to figure out a way to build a platform to get retail investors through RIAs access to those kinds of deals from blue chip sponsors. There are so many regulatory rules. It's between FINRA and the SEC. It's like, I can't afford the compliance function that I would need just to be in the business. So we threw our hands up. We collaborate with syndicators and RIAs all the time, but there's nothing programmatic. I guess iCapital does it, but they're basically a service provider right now. That's really what they do. So I'd love to see that. I'd love to see a pathway for retail investors to invest directly in LP units and real estate deals in a way that help them put good real estate in their portfolio.
I totally agree. I would love for that to happen. Some type of platform. But like you said, there's so many regulatory hoops that one would have to jump through. So it's just pretty much the way it's done. And I know you know this as well. It's, the investors that you've been able to reach out to through your network and referrals. It's pretty much the only way that investors are going to be able to participate in these things. And so what are some of the key trends or challenges you anticipate in the housing market over the next 5 years?
Housing is a supply problem, period, full stop. What I don't understand, even though I do, but it's like a hypothetical, it's a rhetorical what I don't understand, is in a period of rising prices, why is it that home builders aren't building more supply when prices are going up? If you were manufacturing anything in a period of rising prices, you would just make more stuff. Auto industry, car prices are going up. What did the auto industry do? They made more cars. So why? 3 reasons: land, lumber, and labor. There's actually 5 L's. I'm going to go with the first 3: land, lumber, and labor. I don't have to tell you or your audience that labor is scarce and expensive, land that's entitled is scarce and expensive, and lumber, which is the holding place for building materials. Lumber just got more expensive, people. Wildfires in California, lumber just got more expensive. Okay, stop. This is going to happen. Okay, if commodities markets open Monday, go buy lumber futures, because I'm just not investment advice, people, just a rhetorical statement, but like lumber prices are going to go up. Okay. 2 other L's: lenders and laws. Okay. Lenders are still not throwing money at real estate, especially home building. And laws, the regulatory framework for pulling permits and site approvals. And oh my God, like, don't politicians know we have a housing crisis in this country? Like, just get the hell out of the way. Why I moved to Florida, just get out of the way. Let the private sector fix the problem. So we have a supply problem. California is going to have a bigger supply problem. We're actually building attainable housing in Los Angeles. All the projects that we have in Los Angeles, thank God, are out of harm's way. We don't build anywhere near a hill. We don't build in a valley. We build on flat land for a variety of reasons. And our crews are still working as we speak. And we're going to ramp up our site acquisition because we think that there's going to be more need for housing. In California, as of right, you can tear down a single family home and build up to 8 units of multifamily on that site without changing land use. It's a California quirk Okay. It's a good piece of legislation. It's been tested in court. Courts don't want to hear anything about it. They have a housing shortage in California, but their housing shortage in California tragically just got a lot worse. And but that's what we need. We need smart regulations. Around the corner from me, there's a 10,000 square foot site that once upon a time was zoned for 2 single family homes. The geniuses in my town, I'm not saying that sarcastically, in Delray Beach, Florida, are going to approve 5 townhomes on that site. If we're successful in winning that bid, we're going to buy it. We're going to go to the town and say, how about 6, right? We're going to build them fast. We're going to build them economically. We're going to keep the rent as low as possible. But there's a housing shortage here too. Like there's a housing shortage everywhere. Absolutely. And government keeps making it worse. So my trend is, I think you're going to see a relaxation of zoning, relaxation of regulations around housing, because some municipalities are starting to get the memo that deregulation is the way to go. Will there be some brouhaha and then the pendulum's going to swing in the other direction and they're going to bombard us with regulations? Yeah. I'm on Fox, so you don't have to guess which way I lean. But the people who tried to help the housing market the most, Barney Frank and Elizabeth Warren, all they did was hurt it. Okay. The more regulations you throw on a lender, the less loans they're going to make, right? The more regulations you put on a builder, the less you're going to, and I'll kind of leave you with this as it relates to regulation, but my prediction is deregulation is coming to housing. I did a site visit in Vegas in conjunction with the bankruptcy. My cousin Kevin happened to be getting married in Vegas. So I was out there. My whole family's out there on my mother's side. And my aunt, who got a PhD in urban planning, decided she wanted to come with me. My aunt was she just passed away in her late 90s. She's a big tree hugger type. And my aunt wanted to come along a site visit. I was whatever. And I had my 35 millimeter camera. I was taking pictures. I had my little voice recorder recording notes. This is how long ago it was. And my aunt's like, those storm gutters aren't good enough. That roof pitch is wrong. And she's rattling off everything that's wrong with like D.H. Horton built tract development in Henderson, Nevada. And I said, let me ask you a question, Aunt Blanche. You just added back of the envelope about 30% to the building cost of every one of those homes. How in the world is D.H. Horton going to deliver those homes if they now cost 30% more at a price that the people who want to move to Henderson, Nevada in that community can afford? And she goes, trust me, the home builders can afford it. I'm like, no, they can't. Like in a subdivision like that, they don't make money until they sell the last 10 homes. Like you don't understand. Like there's this perception that they're sitting on like, the monopoly guy, like you're sitting on all this cash. So I think we need, and we'll get, my prediction, a wave of state and local deregulation around housing. It's the only means, and believe it or not, of all places in the country to have legislation that is pro construction of new homes is California. In Florida, we have something similar called the Live Local Act that lets you take a commercially zoned property and turn it into a residential use. You do have to get approval. There are capricious towns that give you a hard time about it. Tallahassee, where the governor is, doesn't want to hear any of that crap, but it takes time. But if you have a site for a bank branch that's never going to be built, because no one's building a new bank branch in America. No, there's no new bank branches being built. And we could put 14 on that 1 acre site in a community that needs housing. Why wouldn't they? Right? They're going to get a lot more property taxes. They're going to get a lot more sales tax revenue. They're going to get a lot more of everything. It's a signaled intersection. Like it's everything. That bank branch had a monster location, but in that town, we're trying to tie up that asset, and we're still fighting with the town over and crazy. The site is right near the community center, and there's a great park there. So we think it's an ideal location for young families who can't afford to buy a home, but they'd like a home. So a starter home could be a townhome, and then they could, transition into a home. They could literally push a stroller to a park with swings and grass and all that stuff. The town should love that, but the town is coming up with every reason why. I know it's going to happen. Some dude on the town board, cousin's going to end up buying the site. Like I get how it works. Okay. But Florida's got some legislation that makes sense. California's got some legislation that makes sense. Let the rest of the country, let city of Philadelphia figure that out, right? Let the Philadelphian suburbs figure it out. And by the way, if there's a person that could get behind it, because he's a common sense person, it's John Fetterman. Like I never thought in a million years that dude was loaded with common sense. But John Fetterman is I get it, it's Senate and he has no jurisdiction over state and local, but he may be one of the most common sense people in Washington, D.C. Maybe it's the hoodie, but I think we need at the local level. The only solution to the housing crisis is common sense.
Okay. All right, Mitch, as we begin to wrap this up, please give our audience a little bit of foresight into where you see things going, how things within the housing industry and economy can get better in the future, and what steps would need to be taken to get there.
I think the first step in things getting better happened because the election is behind us. That is not a commentary on who won or who lost. That's a 18-month overhang on this country where there was anxiety about the outcome of the election and capital not getting deployed. I think interest rates are too high, but one of the reasons why they are too high is not because of the Fed. It's the open market, like the 10-year treasury is around 5. So I think Congress has to be able to articulate fiscal policy that makes some sense to ease the capital markets into pricing debt the right way. We also have massive ballooning debt. So if we don't figure out a way to tell the story factually about the fiscal responsibility of the United States, we're going to see an environment of high interest rates for a longer period of time, something that the Fed can't intervene. The Fed can chop down short-term rates all they want, okay? SOFR is still going to be high. The short end of the treasury curve is going to be high. So I think Congress has to do its part. I see a lot of the future of this economy, at least in the first congressional cycle, as being very Reagan-esque. I can't shift my computer to show you the big picture of Ronald Reagan hanging on my wall in my office, but I think it's very, very Reagan-esque. And one thing that period taught me, and I was there, was that capital got deployed during that period because those who put capital at risk felt like the government had their back in terms of keeping the economy going. All right. You can put capital out in a strong economy. You can't get it back if the economy is weak. And the government, the White House, Congress, they're supportive of economic growth and prosperity and private sector empowerment. So my prediction, at least through the midterm elections, is going to be a pro-business, pro-capital allocation environment. And I think that we have a minimum 2-year window to kind of get stuff done. Hopefully banks lighten up and aren't petrified. But I have had too many conversations with too many investors, as you probably have, Cedric, as well, who I was competing, trying to place equity for a deal. I was competing with the 6-month treasury, okay? Because people would say to me, yeah, you got an 8 pref and a 22 IRR on that deal, and that's compelling. But right now, while I can't decide, I'm getting 4.5 on a 6-year treasury. Call me in 6 months. I said 6-year, I meant 6-month treasury. Call me in 6 months. I think we're seeing those yields come down because that's what the Fed is doing. It's now 3 and change. An 8 pref sounds a lot better than 3 and change. And I think we're going to start to see, you asked for predictions, FOMO as it relates to investing, where people are going to feel like you see it in the public equity markets, okay? You see a ton of FOMO. I think that you're going to start to see private capital get aggregated better and deployed in 2025 and 2026. Book me again in 2 years and I'll tell you what the midterm election is going to do. But what I'll tell you is the capital markets don't focus as much on midterm elections as policy geeks like I do. So they'll still be wearing MAGA hats and, racing to the finish line. But I do think that there's a window open right now, and I'm sensing it in term sheets that I've read that have 2025 on the date of them. And I've seen a couple of them. They don't read like they did in November or October of 2024. I think people are starting to get a little, and what happens is, don't forget, capital allocators have bosses. And bosses were risk adverse in 2024. Now bosses are yelling at them to put money out. So that's my prediction for, I don't know if we're going to be doing a lot of this, but that's my prediction for 2025 and 2026. Also my dream, my hope.
Mine as well. I want those bosses, like you say, that was kind of skittish in 24 to like, hey, put that money to work. Let's find viable syndicators, fund managers to put that money out in the street in good products and get our investors a great return. So that's what I'm hoping for as well. Well, Mitch, it has been a blast having you as our guest today. As we close out, please tell our listeners where we can learn more about you, get in touch with you, and learn about all the fabulous things you have going on right now.
You know, a good way to do that is to follow me on X, formerly known as Twitter, which is Mitch_Rochelle, and Rochelle is spelled ROS, like Sam, CHELLE, and you'll probably put it in the notes or something like that. The only problem is you got to sort through my political views because I share them readily on X because I can now. I was deplatformed a couple of times, so I won't get deplatformed. The other thing you can do is I speak about 5 times a year at something called The Money Show. You'll see me post about that. Definitely, without a doubt, think about attending The Money Show. It's a great platform. Also, follow me on LinkedIn. I think that if you want a little less politics and point of view, I do post a lot of content on LinkedIn, and you can find out more from my LinkedIn bio about Madison Ventures Plus and our portfolio companies. So why don't you start? If you don't like politics, looking for me on LinkedIn. If you like politics, you can follow me on X. And if you don't agree with me, I'm very respectful of anybody who has a difference of opinion. You talk about what makes America great. Differences of opinion is what makes America great. And what was frightening was when we didn't allow differences of opinion. Okay. We should always allow. I think who said it? I think the Washington Post said democracy dies in darkness. And I think we're entering a new era where media platforms are going to stop moderating content and telling people what they're supposed to think. I'll let people decide for themselves. Americans aren't stupid. So if you don't agree with something I have to say, post a comment. I have no problem with that. I love debate.
Awesome, Mitch. Again, I want to thank you for your time today and all the wisdom you have provided to my listeners. It's greatly appreciated. And I want to thank you, our fans, for tuning into the Service to Syndication podcast, where we want to provide value to you and your investing business. Please tune in to our next episode where we will interview another fantastic investing professional. See you next time.
Thanks for listening to the Service to Syndication podcast. We want you to know that we love and appreciate your support, and we are grateful about being a part of your journey to becoming a successful real estate entrepreneur. Please share this episode with a friend who you think will get a lot out of what you just heard. Send it to someone who you know is interested in real estate and dreams of having it all and being the best they can be in all areas of life. And if this was really valuable, share it on your social media stories and timelines. Thank you for watching and listening. Now go be great.